Hi everybody, Derek Bissen here, and today's topic is ARM loans. Now, has anybody ever mentioned to you about an ARM loan and you thought to yourself, what is that? Well, an ARM loan is just short for adjustable rate mortgages. And in certain circumstances, it can be a very, very useful tool. In this video, we're going to cover everything you need to know about an ARM loan so you can discover whether or not this is the type of loan program that is right for your scenario and your goals. And even if this is your first time or if you've had an ARM loan before, I promise you, by the time this video is over, you're going to have a much better fundamental understanding of how this loan program works. Let's get started. So from time to time, you may encounter this type of loan program. A jumbo loan is extremely useful for super large loan amounts, those that are over the Fannie Mae or Freddie Mac loan limit for a given area. They're extremely useful tools for that type of financing. They typically have lower interest rates than their fixed rate counterparts, and they can also be employed by lenders who are lending to foreign nationals or citizens of countries outside the United States. An ARM loan is a loan with a 30-year payment schedule where the interest rate is fixed for a certain number of years at the beginning of the loan. After that fixed period is over, the loan then enters an adjustment period where the interest rate adjusts one time per year and can move up or down with the market until the loan pays off in full in 30 years. When it comes to ARM loans, the single most important thing that you can understand is how this loan can change over time. If you can get a good working understanding of this, then you'll have the confidence to know if this is the right type of loan program. Let's check out how it works. So first, let's cover some basic terms you'll need to know. I'll include these in the description below. First, the name of the program. This is a great starting place because the name of the program will often tell you a great deal about the loan itself. For instance, a 5-1 ARM basically means it's a 30-year loan where the interest rate is fixed for the first 5 years. If it were, say, a 10-1 ARM, then it would be a 30-year loan where the interest rate is fixed for the first 10 years. Next up is caps. The caps or the interest rate caps are your protection against skyrocketing interest rates and monthly payment shock in the future. We're going to cover these more in depth in a moment. The floor. This is the lowest that your interest rate can go for the life of the loan. The ceiling, sometimes referred to as the lifetime cap. Now this is the highest that your interest rate can ever rise during the life of the loan. The interest rate. This is the starting interest rate for your new loan. Now, the interest rate is broken into two different parts, the index and the margin. So we're going to cover the index. The index is one of the two core components of your interest rate. The index is usually a publicly available number, such as the 1-year U.S. Treasury rate. The margin is the second component of your interest rate. It can be helpful to think of the margin as basically the bank's profit margin. When combined, the index and margin create the new rate and will ultimately guide what happens to your new loan in the future. Now that we've covered the terminology, let's slide over and talk about the caps or your protections in the life of the loan. Like all ARM loans, you'll have protections against future skyrocketing interest rates. These are called caps. If interest rates rise significantly during the life of the loan, it'll be the caps that will set a maximum for your new interest rate and monthly payment. The caps are often shown in a series of 3 numbers. The first digit of the sequence determines the maximum that the interest rate can rise at the beginning of the first adjustment phase of the loan just after the fixed rate period is over. The second digit defines that the maximum increase or decrease you can expect in the remaining annual adjustment periods. The final digit in the series is often known as the lifetime cap or ceiling. The lifetime cap is your highest interest rate that you can see during the life of this loan. The floor of the loan is the lowest interest rate you will ever see during the life of the loan. Regardless of what happens to the index over time, in most cases, the floor will be equal to the start rate. So even if rates plummeted below your original start rate, your start rate would most likely be the lowest rate you would ever see on your loan. So now that we've covered the caps, let's jump into a concept example using our 5-1 ARM program. Now this program has caps that are 2.26. It has a margin of 2.75. It is based on the 1-year US Treasury, and the floor is equal to the start rate. The interest rate is fixed for the first 5 years, and the monthly principal and interest payments you pay would remain the same for the first 5 years. At the beginning of month 61, the loan enters its adjustable phase for the next 25 years. The interest rate will then readjust every 12 months for the remaining 25 years until the loan is paid in full. The interest rate will trend upwards or downwards with the index, again, the 1-year US Treasury index, which is publicly available online. This loan has those built-in protection caps, which are 2.26. So here's how your lender calculates the new rate when your loan enters the adjustment period. At the time that the loan nears its adjustment phase, your lender will research the current index, again for this loan program, the 1-year US Treasury index, and then we'll add it together with the bank's profit margin, which is 2.75. Then this new number is then compared to your caps or protections, and then whichever the two numbers is lower then becomes the new interest rate for your loan for the next 12 months. This loan program repeats one time each year until the loan pays off. Okay, so now that we've covered the concept, let's go right into an actual example using the same loan program. This will be our 5-1 ARM, and we'll assume that the rate is going to start off at 4.25. In the first adjustment period, 5 years from now, we find that the 1-year US Treasury index has risen to 4.5%. If we add in the margin of 2.75 to the 4.5, we get a total of 7.25. That would theoretically be your new interest rate. However, you have those caps that protect you, so your new rate will only rise to 6.25. And again, why? It's because the loan has an annual cap rate of 2% from the previous year's interest rate. So 4.25 plus 2% cap is 6.25, which is why you get the lower of those two rates. This process repeats itself each year until the loan pays off. Since the lifetime cap of this loan is 6, that means that your interest rate can never rise above 10.25, which is 6% higher than the original start rate of 4.25. And there you have it. We hope you found this information helpful and informative. If you did, consider subscribing to the channel, hitting that like button, and smashing that little bell so that you'll be alerted when new content arrives. If you have more questions about ARM loans, drop a comment in the description below and we'll do our best to get back with you. And of course, if you're looking to purchase, refinance, or get pre-approved to purchase your next home anywhere in the state of Florida, we would love to assist you. Thanks again for watching. I'm A Bissen, and this is Unconventional Lending.